So if you wanted to build like the most advanced AI supercomputer in Southeast Asia, a facility pulling enough power to literally run a small city, you probably wouldn't ask a Silicon Valley software startup to do it.
Right. You definitely wouldn't.
You'd probably ask a company that spent, the last 20 years quietly boiling water, managing power grids, and laying sewage pipes.
Yeah, exactly.
Because today, we are looking at how a utility company that was trading at like 50 cents just a few years ago accidentally positioned itself to become the landlord of the global AI revolution.
It's the ultimate pivot. We are talking about a structural paradigm shift here, where the boring, totally predictable business of moving water and gas has somehow funded this massive leap into bleeding-edge technology.
It's wild. Welcome, everyone, to our first ever official deep dive into YTL Power International Burhead. That's stock code 6742, right here on the Night Eyes 08 channel. We are incredibly pumped to peel back the layers on this one.
Oh, absolutely.
Because if you've been watching the ticker, you know this story defies pretty much all normal market logic. YTL Power is currently sitting around RM 5.36, which is up roughly 25% over the past year.
Right.
But if you zoom out to the 5-year chart, we are talking about an astronomical multi-bagger rally of over 600%.
Which is a trajectory that's practically unheard of for an asset-heavy infrastructure player.
Yeah.
You do not see regulated utility monopolies suddenly charting like hyper-growth tech stocks.
No, never. So the core mission, the central question driving today's deep dive for you, the listener, is this. Why has YTL Power grown so much? Is this multi-bagger rally fundamentally justified by the underlying cash flows? Or is this stock, severely overheating?
Right. Are we looking at a bubble fueled by AI hype or the birth of a genuine digital infrastructure giant?
Exactly.
And to answer that with actual data rather than just, narrative, we've brought a massive stack of sources to the table today. We are pulling from the absolute latest August 2026 broker report.
The really dense one.
Oh, yeah. Specifically, the deep analytical models from ME Investment Bank, RHB, and TA Securities. We've also consolidated the full financial and segment data tracing all the way from FY 2021 through to the newly released Q4 FY 2026 interim results.
Which just dropped.
Right. And perhaps most importantly for you, if you're trying to price this stock, we have comprehensive internal analyses on their economic moat, their rather terrifying leverage structures, and our own sum of the parts valuation models.
And what's fascinating here is that we basically have to throw out the traditional playbook. You just cannot use the standard rules for valuing the utility company on YTL Power anymore.
It completely breaks the models.
It really does. As we dive into this over the next hour, I want you to keep your own portfolio top of mind. Put yourself in the shoes of the institutional investors who are actively struggling to figure out exactly what kind of beast YTL Power actually is today.
Because treating it just like a power company will cause you to completely misprice its future, and treating it just like a tech stock ignores, the massive regulatory realities of its legacy assets.
Yeah. So let's start by looking backward, because you really can't appreciate a 600% rally without understanding the absolute misery that shareholders went through to get here.
Oh, it was brutal.
Let's look at the 10-year cycle and this multi-year financial trajectory. How did a stock that is now trading above RM 5.30 spend so much time priced like a literal penny stock?
Well, we have to view this through 3 distinct eras. The first era is the downtrend and stagnation phase, which ran basically from 2016 through 2022. During this period, YTL Power stock essentially wallowed in the mud.
Right.
It traded slowly downwards from around RM 1.50, grinding all the way down to a basement of about 50 to 60 cents.
I mean, imagine buying at 50 cents.
Yep.
But the thing is, back then, nobody wanted to touch this company. Why was the market treating a massive utility conglomerate like toxic waste?
It was suffering a perfect storm of negative catalysts across its most reliable cash-generating divisions. First, let's look at Malaysia. They were facing expiring power purchase agreements, or PPAs.
Let's define that for a second for anyone newer to utilities. A PPA isn't just a loose agreement. It's the lifeblood of an independent power producer.
Correct. When you build a multi-billion ringgit power plant, you don't just hope people buy the electricity. You sign a PPA, a guaranteed ironclad contract where the government or the national grid operator agrees to buy your power at a set price for, say, 20 years.
Okay, yeah.
But these contracts have expiration dates. As YTL's legacy Malaysian PPAs began to expire, the government wasn't exactly rushing to renew them on the same favorable terms, so the guaranteed cash flow just vanished.
Wow. So the golden goose stopped laying eggs locally, But they are a global company. What was happening overseas?
Right, so half a world away in the UK, their massive water and sewerage segment Wessex Water was getting squeezed tight by regulators. The UK water regulator, known as Ofwat, set strict limits on how much water companies can charge consumers.
Okay.
And during this period, Ofwat tightened regulatory requirements, demanding massive capital upgrades to aging pipes and sewage systems, right as inflation started creeping up.
Oh, man. So to summarize the stagnation era, the Malaysian power plants are losing their guaranteed revenue, and the UK water business is being forced to spend billions on maintenance while being legally barred from raising prices to cover it.
Exactly.
Well, that completely explains the 50-cent stock price.
It does, but then we hit the inflection point. The second era, the AI and power re-rating phase of 2023 to 2024. Suddenly, the stock explodes out of that basement, tearing past RM 1.000, RM 3.00, all the way past RM 5.00.
And I want to be clear here, this wasn't just like meme stock magic. There were two massive, tangible, fundamental drivers that fundamentally altered their balance sheet. We'll start with Singapore.
Yes. Their subsidiary, YTL PowerSeraya, suddenly found itself in an incredibly favorable and frankly quite rare market environment. PowerSeraya generated booming profits that caught almost all analysts completely off guard.
But how did they manage to make so much money so fast in Singapore? I mean, electricity is usually a heavily managed market.
Singapore operates a liberalized energy market. Let's break down the mechanics. Unlike a traditional monopoly, power generation companies in Singapore sell electricity into a wholesale market, but they also sell directly to retail consumers and businesses through locked-in contracts.
Right.
During this period, global energy markets were totally chaotic. But PowerSeraya's management executed a brilliant hedging and contracting strategy.
Okay, let's unpack this. What did they actually do?
They locked in retail energy contracts with major corporate and commercial customers for 1 to 2 years at highly favorable profit margin spreads.
Ah, I see.
Essentially, while their competitors were getting battered by volatile spot prices for the natural gas needed to run the turbines, PowerSeraya had secured their future revenue at high prices while maintaining control over their input costs. They became an absolute cash-gushing engine.
Which provided the funding for the second massive driver. The bombshell announcement that changed their identity, forever partnering with NVIDIA to build AI data centers in Johor.
That was the spark that lit the powder keg. The market suddenly realized this wasn't just a struggling water and gas company anymore. They were partnering with literally the most valuable semiconductor company on Earth to build sovereign AI infrastructure.
Yeah.
We went from analyzing pipe corrosion to analyzing GPU compute capacity overnight.
And that brings us to the third era, which is where we are right now. The volatility and growth phase of 2025 and 2026. Because a 600% straight lineup just doesn't happen without turbulence.
Oh, of course not.
The stock had this insane run, but then it consolidated. It actually fell back hard into the RM3 area 0.80 again to RM 3.50 range during mid-2025 and early 2026.
Which naturally triggered a lot of panic selling from retail investors who thought, the AI bubble had popped.
Right, but then it bounced back strongly to where we are today, hovering around RM 5.36. Why the massive dip and subsequent recovery?
That consolidation was mathematically necessary. The initial rally to RM 5.00 was based entirely on the announcement of the AI partnership and the peak profits of Singapore. But building a data center takes time.
A lot of time.
Exactly. The market was digesting the massive run-up and waiting to see if YTL could actually execute, if those AI dreams would ever translate into actual earnings on the bottom line. The recent bounce back to RM 5.36 is because the market is finally seeing the execution, the physical servers are being installed, and the revenue is starting to flow.
Speaking of revenue flowing, let's follow the money. We've got the comprehensive segment-by-segment breakdown from FY21 through FY25. If I'm an investor looking at a RM 22 billion revenue pie, I need to know exactly which slices are feeding me and which ones are starving me.
Let's start with the undisputed heavyweight champion of their portfolio, power generation. If we look at the historical data, revenue in this specific segment jumped from RM 6.2 billion in FY21 to over RM 12.1 billion in FY25.
Wow.
It essentially doubled in a 4-year span.
But, revenue is vanity, profit is sanity. How much of the actual bottom line is this segment carrying?
Over the last 5 years, this single division has driven over 80% of the group's historical pre-tax profit.
80%? That's insane.
Yeah, PowerSeraya in Singapore is the ultimate cash cow. Without the massive liquidity generated by those locked-in Singaporean retail contracts, YTL Power simply would not have had the balance sheet strength to launch a multi-billion ringgit data center build-out. PowerSeraya funded the AI dream.
Now let's contrast that cash machine with the water and sewerage segment, the Wessex water operation in the UK. This division's journey has been wild. Revenue grew nicely, from RM 3.7 billion in FY21 to over RM 7 billion in FY25. But the profitability is a total roller coaster.
It is the definition of regulatory whiplash. Look at FY24. Wessex Water posted a massive loss before tax of negative RM 100 million.
I mean, how does a monopoly water provider lose 100 million ringgit? Did people just stop drinking water?
No, the regulatory lag caught up to them. We talked about Ofwat earlier. In FY24, the UK experienced severe inflation. The cost of chemicals to treat the water, the cost of electricity to pump it, the cost of labor to fix the pipes, all of those input costs skyrocketed.
Right.
But because their consumer tariffs are locked by the regulator, Wessex had to eat all of those inflated costs directly. They couldn't pass it on to the consumer immediately. The margin just vanished.
But then look at FY25. They swung from a negative RM 100 million loss back to a positive RM 384 million profit before tax. That is nearly a $500 million ringgit turnaround in 12 months.
Which demonstrates the power of a regulatory reset. Crucial UK tariff hikes finally kicked in. Ofwat allowed them to raise the prices they charge customers to finally account for that previous inflation. The profitability was instantly restored by the stroke of a regulatory pen.
Okay, so Wessex Water transitioned from a defensive drag back into a steady, reliable contributor.
Exactly.
So power is the cash cow, water is the reliable defensive shield. Now let's look at the bleeding edge, the segment that is really testing investor patience telecommunications, specifically the YES 5G network.
Yeah. This is the glaring sore spot on the income statement. It continues to be deeply loss-making. In FY25 alone, they posted a pre-tax loss of negative RM 255 million.
Ouch. The revenue is slowly creeping upward as they gain some market share, but a $250 million ringgit loss is heavy. Why did they hold on to it? If I'm a ruthless corporate raider, I'd spin that off or shut it down tomorrow to instantly boost my bottom line.
I'd frame it slightly differently. You have to look at management's long-term vision for a complete digital ecosystem. Telecommunications infrastructure is an incredibly long gestation play. More importantly, having a captive, high-speed 5G network integrates perfectly with their broader digital infrastructure ambitions. If you are building sovereign AI data centers, having your own telecommunications backbone to move that data securely across the country is a huge strategic advantage. It's a financial drag today, but they view it as a critical piece of the puzzle for tomorrow.
And finally, we have the wildcard segment, investment holdings. Most retail investors just gloss over this line item in the annual report, but the data here shows a massive 112% compound annual growth rate in profit before tax over the last 5 years. Where is that coming from?
This segment is a quiet powerhouse. It includes their share of earnings from associate companies where they don't have full operational control, but they own a significant stake. The prime examples are the PT Jawa power plant in Indonesia and the Adarat power plant in Jordan.
Oh, interesting.
It's a potent contributor to the bottom line that the market often overlooks because it doesn't have the flashiness of AI or the scale of Wessex Water.
Right. I promised the listeners we would actually show them the math. We are about to dive into a 15-metric financial trend analysis. This is the Show Me the Numbers segment. I want to look at exactly how this transformation has warped their balance sheet and income statement. Let's start with profitability trends.
Perfect. So we need to look closely at return on equity, or ROE. This metric is foundational. It tells us how efficiently management is generating profits using the shareholders' invested capital.
Right.
YTL Power's ROE peaked at a very impressive 17% during the height of the Singapore power boom in FY24, but it has trended downwards, moderating to 9.2% in FY26.
And return on assets, ROA, tells the exact same story. It peaked at 5.1% in FY24, but it's down to 2.3% in FY26. Now, hold on. I have to push back here.
Sure.
If the stock is up 600% and the AI narrative is so strong, why are the core profitability ratios cut in half over the last 2 years?
That is a fantastic question, and it requires understanding the denominator effect in these formulas. Remember, ROA is net income divided by total assets. ROE is net income divided by shareholder equity.
Okay, basic division.
Right. And over the last 2 years, YTL Power has poured billions of ringgit into building out these new data centers. They are accumulating massive new physical assets and retaining earnings to fund them, which balloons the equity base.
Ah, so the bottom of the fraction is getting much, much bigger.
Exactly. The asset and equity base expanded massively. At the exact same time, the hyper profits from the Singapore power contracts naturally normalized slightly after peaking. So you have slightly moderated net profits divided by a vastly larger asset base. The ratio mathematically has to drop.
It doesn't mean the business is failing.
Right. It means the capital structure is in a heavy build-out phase.
That makes perfect sense. It's like expanding your restaurant to seat twice as many people. Your return on those assets drops while the new tables are empty, even if the business is fundamentally growing.
Spot.
Let's shift to income and revenue. The trend line for revenue is generally upward to sideways, hovering tightly in that RM 22 billion range. But net income and earnings per share, or EPS, are moderating after that FY24 turnaround. EPS sits at 19.58 sen for FY26.
Which, we should note, is still a spectacular recovery from the negative EPS they suffered back in FY21. But it proves that the easy turnaround money has been made. The stock price is already priced in the recovery of the legacy assets. We are now purely in the execution phase for future growth.
Now let's talk about liquidity, because this is where I get genuinely nervous looking at the raw data. The current ratio has trended severely downward to 0.81x, and the quick ratio is down to 0.76x in FY26.
Yeah, those are flashing red lights for a traditional value investor.
Just to make sure everyone's on the same page, a current ratio measures a company's ability to pay its short-term obligations. A ratio below 1.0 mathematically means YTL Power has more liabilities coming due in the next 12 months than it has liquid assets like cash or inventory to pay them off.
Yeah.
Are they suffocating under the weight of their own growth?
It's a totally valid concern, and it is the single most frequent criticism the bears point out. This liquidity squeeze is the direct, unavoidable byproduct of their structural transition.
Oh, because of the data centers.
Yes. They are heavily utilizing short-term debt and revolving credit facilities to fund massive, long-term, highly illiquid capital projects, namely laying concrete and buying servers in Johor.
Which brings us perfectly to cash flows and ROIC, return on invested capital. Operating cash flow, the actual cash generated from their daily business, is still strong. It's trending upward, but moderated slightly at RM 2.44 billion in FY26. So the core business is throwing off cash.
Right.
But free cash flow, it has completely fallen off a cliff, aggressively downward to a negative RM 5.47 billion in FY26, and ROIC dropped to 6.8%.
This is the crux of the entire financial puzzle. Why is free cash flow negative 5.5 billion ringgit? Because of the gestation period of massive capital deployment.
Yeah.
Think of the engineering reality here. They are pouring billions of ringgit into the ground. They are building substations, massive cooling towers, and securing thousands of highly expensive NVIDIA GPUs.
Right. You have to completely finish building the physical data center, plug it in, and test it before you can charge a tech company a single cent of rent to put their data in it.
That is the definition of a J-curve investment profile. The cash goes out the door today. That's the massive capital expenditure, or CapEx, but the run rate revenues won't start flowing in for another 18 to 24 months until the servers are online and the clients are actively billed. The financials inevitably look their absolute worst right before they get exponentially better.
That's a great way to put it. Let's round out the numbers with some utility and infra-specific ratios, because you can't value a company with a massive network of water pipes the same way you value a software startup. Let's look at debt to equity, or gearing. Despite the massive CapEx, it has actually stabilized nicely around 54%.
Which is very healthy for a capital-intensive infrastructure player. They are managing the equity side well.
Now, enterprise value to EBITDA, or EBITDA. For those unfamiliar, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
It's a mouthful.
It is. But it's a great metric for companies with huge physical assets because it strips out the massive non-cash depreciation charges, giving you a clearer picture of operational cash earnings. Their EBITDA is hovering around 10.3x in FY26, but the broker model is projected to compress to 8.6x as the AI earnings come online.
Which indicates the stock is actually getting cheaper relative to its operating earnings over time.
But then we look at net debt to EBITDA, which measures how many years it would take to pay off all their debt using their current operational earnings. This metric widened from 3.90x in FY25 to 5.0x in FY26.
Again, reflecting that aggressive CapEx spend, drawing down their cash reserves and increasing their borrowings. And finally, when analysts look at the UK water business, they don't use standard PE ratios. They use a metric called price to RAV, or regulated asset value.
I see this in every British utility report. What exactly is regulated asset value?
It is the absolute gold standard for pricing regulated monopolies. It essentially measures the market value of the company against the replacement cost of its core infrastructure network, as officially recognized by the regulator.
No, I see.
So if Wessex Water has a RAV of £4 billion, it means Ofwat officially recognizes they have £4 billion worth of physical pipes and treatment plants in the ground. YTL Power usually trades at a slight premium to RAV because they operate efficiently.
It's just wild how you have to use completely different mathematical yardsticks for different parts of this single company. Now, I want to pivot away from the historical trends and dissect the absolute latest real-time data we have, the Q4 FY2026 earnings and balance sheet. This is the fresh intelligence.
Yeah, this report literally just dropped, and it tells a very compelling, nuanced story about execution.
Let's lead with the headline numbers. The Q4 FY2026 results showed core PKMI, which is profit after tax and minority interests, essentially the pure profit belonging to YTL shareholders, rebounding strongly by 74% quarter-on-quarter to RM 646.6 million, according to the Hong Leong Group analysis.
That's a huge jump.
Yeah, and that phenomenal fourth quarter brings the full-year figure to around RM 1.7 to RM 1.9 billion, depending on how you adjust for core versus headline items.
The adjustments are vital here. TA Securities and RHB both had to make specific EPS adjustments because of the noise in the quarter, one-off gains or losses that obscure the true operating performance.
Right.
RHB noted that the FY26 core earnings of RM 1.9 billion were actually a beat on market expectations, hitting 106% of the consensus full-year figure, even though the raw number was down year over year.
But wait, I'm looking at the AMI Investment Bank report, and they had a slightly different take. They noted that earnings actually missed some of their consensus estimates by 13%. How can RHB call it a beat and AMI Invest call it a miss?
It all comes down to the tax man.
Always does.
Yeah. AMI Invest points out that YTL Power fell short of their specific net profit estimates due to a surprisingly higher than expected effective tax rate. The rate jumped to 26.6% in FY26, up significantly from 20% in FY25.
Why such a massive jump? Did the Malaysian government just decide to arbitrarily tax utility companies more this year?
No, it's an accounting issue. It happened because there were significantly more expenses incurred this year that were simply not tax deductible under standard accounting rules.
What does a non-tax deductible expense actually look like for a company this size?
It could be several things. Often it's depreciation on non-qualifying capital assets, certain types of specific financing costs related to their aggressive expansion, or even penalties. The point is, the gross operational profit was exactly what analysts expected, but the tax authority didn't allow them to write off as many expenses.
So the government took a bigger bite.
Exactly. So the government took a bigger bite than the models predicted. That dragged down the final net profit number.
Okay, let's address the PowerSeraya hiccup. We just spent 20 minutes praising Singapore as the ultimate cash cow, but in FY26, their pre-tax profit sank by a massive 47% to RM 1.5 billion. It was almost cut in half. What on earth happened?
The source texts point to a very specific, unpredictable geopolitical event. YTL PowerSeraya had its critical natural gas supply disrupted by the escalation of the Iran war.
A conflict in the Middle East directly slashing the profit of a power plant in Singapore by 47%. The butterfly effect in global markets is terrifying.
It really is. This is the reality of global energy. Because their primary contracted LNG fuel supply was disrupted in transit, YTL Power was caught in a brutal squeeze. To fulfill the retail electricity contracts they had already locked in with their customers, they were forced to go out into the volatile open spot market and buy expensive replacement electricity and gas.
So they were forced to buy their fuel at sky-high emergency prices, but they were legally forced to sell the resulting electricity at their already locked-in lower contract prices.
Precisely. They swallowed the spread. That, combined with some scheduled necessary plant maintenance shutdowns where turbines were offline, severely compressed their retail margins for the entire year.
Here's where it gets really interesting, though. While Singapore was taking a heavy geopolitical hit, let's look at the data center explosion, because this is the absolute star of the show right now. The data center unit's pre-tax profit leaped from RM 59.3 million in Q3 to an astonishing RM 244.3 million in Q4 alone.
That is a staggering jump in a single 3-month period. It brought the total pre-tax profit for the data center division to RM 345.5 million for the full FY26 year.
I mean, how do you mathematically quadruple your profit in one quarter? Did they just find loose change in the couch cushions?
It is entirely driven by opacity rollout and the strict rules of revenue recognition in tech real estate. As of the end of June 2026, they officially had 150 megawatts of data center capacity commissioned and handed over to clients.
Wow.
The massive Q4 performance was partly due to earnings being heavily backloaded as they rapidly ramped up utilization of those servers, and partly due to some delayed revenue recognition from the earlier quarters finally being cleared by auditors and hitting the books all at once.
And they are stepping on the gas.
Yeah.
They're targeting 258 megawatts to be fully commissioned by the end of FY27.
That rapid physical deployment of servers and the accompanying cooling infrastructure is translating directly and aggressively into bottom-line profit. The execution risk is paying off.
But we have to address the elephant in the room again, debt and CapEx. We touched on the liquidity ratios, but let's look at the sobering reality of the Q4 balance sheet. CapEx was a staggering RM 7.91 billion in FY26. Consolidated net debt is sitting at over RM 31.2 billion. Let me repeat that for the listeners. 31.2 billion ringgit in debt.
Yeah, when retail investors see 31 billion in debt, they instinctively want to run for the hills.
Right.
But if we connect this to the bigger picture, looking for net cash is the completely wrong analytical framework for a utility or infrastructure play.
Hold on, I get that infrastructure takes debt, but an AI data center isn't a water pipe. Water pipes last a century. Technology becomes obsolete in 3 years. How can you confidently lever up a balance sheet with RM 31 billion for a quote-unquote long-term asset when the NVIDIA chips inside it might be outdated by 2028?
That is the exact debate happening in institutional boardrooms right now. You are confusing the real estate with the hardware. YTL is largely building the shell, the massive power substations, the advanced liquid cooling infrastructure, the physical security. The tech companies often bring their own rapidly depreciating servers or sign leases that account for hardware refresh cycles. The building and the power connection have a multi-decade lifespan. That's why they use debt.
So what debt metrics should I actually care about if the absolute number doesn't matter?
The metrics that dictate solvency are debt to EBITDA and interest coverage. We noted their gross debt to EBITDA is 6.39x and net debt to EBITDA is 5.00x. But let's focus on interest coverage, meaning how many times their operating profit can pay their annual interest bill. It is down to 2.25x in FY26.
2.25x. That means for every single dollar of interest they owe the bank this year, they are generating $2.25 of operating profit. It's much tighter than it was a few years ago when it was well over 4x, but they aren't going to default on Monday.
Right. It is a highly calculated leveraging of the balance sheet to capture what management views as a once-in-a-generation growth opportunity in AI. But you are right to be cautious. It requires absolutely flawless execution. There's very little margin for error at 2.25x coverage.
Speaking of flawless execution, I want to take a quick second to execute a flawless call to action. If you're enjoying this incredibly deep dive into the mechanics of YTL Power, please smash that like button right now. It tells the algorithm this research is valuable. Drop a comment below, and whether you hold YTL Power seriously, let us know your average entry price. We love seeing the community's positions. And subscribe to Night Eyes 08 for more institutional-grade Bursa Malaysia updates.
I'll just jump in to emphasize that the community's insights in the comments truly spark our best future deep dives. We read them all, and they actively shape the analytical models we choose to build next.
All right, moving into the critical phase of our analysis, the valuation model and the hidden catalysts. This is where we figure out what the stock is actually worth today, and more importantly, tomorrow. Let's start with the big philosophical debate tearing analysts apart. Is YTL Power a growth stock, or is it still a dividend play? Because it's yielding a rather paltry 1.6% to 2.0% dividend right now.
It is a company entirely undergoing a metamorphosis. Historically, if you bought YTL Power 5 years ago, you valued it on its price to free cash flow. You bought it purely for the reliable dividend check. But today, the market is actively trying to price it as a tech growth hybrid.
And that fundamentally changes the mathematical models you use to price the shares.
Completely. The market is shifting to value it on a forward PE price-to-earnings basis. Look at the PE compression we are seeing in the broker forecasts. The stock was trading at a trailing PE of around 28x during the FY26 earnings hiccup. But because earnings from the data centers are projected to explode over the next 3 years, that PE is forecasted to drop aggressively to roughly 15x or 16x by FY27 and down to around a remarkably cheap 13x by FY29.
Meaning, if the stock price stayed exactly where it is today at RM 5.36, it would look incredibly undervalued in 2 years based on the new, massive earnings coming online.
Exactly. That's why brokers are assigning it a target PE of 19x or 20x today, pulling forward that anticipated growth into today's share price.
Now, you and the team built a comprehensive valuation model based on the source documents, and you explicitly noted that a standard DCF, discounted cash flow model, completely fails here. Why shouldn't a retail investor just pull up a standard DCF calculator online, plug in YTL Power's numbers, and trust the output?
Because a single entity DCF will give you a wildly inaccurate and usually severely pessimistic intrinsic value. There are two main mathematical reasons. First, the heavy front-loaded AI capex we just discussed completely drags down near-term free cash flow into the negative billions. A standard DCF penalizes negative near-term cash flows heavily in its terminal value calculation.
I see.
Second, and much more importantly, the weighted average cost of capital, or WACC, is vastly different across their segments.
Let's explain WACC. It's essentially the average rate a company pays to finance its assets, right?
Right.
But it also represents the risk profile. You can't use the same risk discount rate for a regulated, boring 100-year-old UK water pipeline as you do for a bleeding-edge, speculative NVIDIA AI supercomputer in Johor.
That is the perfect way to look at it. The UK water asset has incredibly low risk. It's a monopoly with guaranteed demand. Therefore, it requires a very low WACC, maybe 4% or 5%.
Right.
But the AI infrastructure is high risk, high reward, facing massive technological obsolescence risks, requiring a much higher WACC, maybe 12% or 15%. If you blend those two completely different risk profiles into one single DCF discount rate, you get a nonsense number.
Think of valuing YTL Power like appraising a piece of real estate that has a functioning, boring laundromat on the first floor, but a literal, unmined gold vein discovered in the basement. A standard DCF model just looks at the whole building's current cash flow, heavily weighting the quarters from the laundromat because that's what's currently producing cash. It mathematically ignores the unmined gold because it requires upfront capital to extract. Sum of the parts, or SOTP, forces us to appraise the laundromat and the gold mine as two entirely separate, distinct businesses and add them together.
That is an excellent analogy. SOTP is the only academically sound way to value this conglomerate.
Okay, let's break down the two SOTP scenarios you ran from the data. Scenario A is EBITDA-based, and Scenario B is PBT-based.
Let's start with Scenario A, where we value the distinct segments based on their projected EBITDA multiples. We assign high tech-like multiples to the data centers and stable, lower multiples to the utilities like PowerSeraya and Wessex Water. Adding those parts together, we arrive at an intrinsic value range of RM 3.61 to RM 4.66 per share.
Okay, and Scenario B?
Scenario B is our more conservative model based on profit before tax PBT metrics, which strips out some of the leverage effects. That yields a lower intrinsic value of RM 2.41 to RM 3.06 per share.
Wait a second, I have to call a timeout here. The stock is currently trading on the open market at RM 5.36. Even your most optimistic Scenario A tops out at RM 4.66. Are you sitting here telling our listeners that YTL Power is fundamentally overvalued right now? Because the institutional brokers absolutely do not think so. AMA Invest has a target of RM 6.86, RHB says RM 7.00, and Hong Leong is all the way up at a bullish RM 7.58. How can our baseline SOTP be lower than the current stock price and drastically lower than the broker targets?
This raises an incredibly important question, and it is the absolute crux of the entire bull thesis for YTL Power. Our base SOTP models, and frankly the models of most conservative retail investors, only value what is currently visible and generating near-term projected cash flow.
Ah, okay.
But the stock is trading at a premium to those models because of what we call the massive hidden upside.
Ah, the stuff that is priced at literal zero on the spreadsheet, but has immense real-world potential. Let's push back on our own conservative numbers and reveal what analysts might be missing or refusing to model. Hidden catalyst number 1, ILMU Sovereign AI Software and YTL AI Labs.
If you look closely at the broker SOTP spreadsheets, they are exclusively valuing the physical data center buildings, the co-location space, the power, the cooling. But YTL isn't just acting as a dumb landlord. They're actively building a sovereign AI software ecosystem.
When we say sovereign AI, we aren't just throwing around a Silicon Valley buzzword. What does that actually mean?
It's about data security and national jurisdiction. We are talking about highly sensitive data, government records, local banking data, healthcare files that legally or strategically cannot cross an international border.
That makes sense.
Right. For the Malaysian government or local financial institutions, sending that data to a server in California to be processed by an AI model is a massive security risk. YTL is building the physical infrastructure and the software layers so the AI processing happens legally and physically on Malaysian soil. That commands a massive premium.
But because it isn't generating predictable, recurring subscription revenue yet, conservative analysts have assigned this entire software ecosystem exactly zero value in their models. If they successfully launch an enterprise AI cloud platform, the margins on software make infrastructure leasing look like a joke. Valuing that at zero seems crazy to me. Moving on, hidden catalyst number 2, Reapbank.
This is their digital bank joint venture with C Limited, the parent company of Shopee, the e-commerce giant. They successfully won one of the highly coveted digital banking licenses in Malaysia.
And how much value is assigned to a licensed digital bank in the current target prices?
In almost all the models we reviewed, zero. It's in its infancy. It's currently burning startup capital to acquire customers, so it gets no valuation credit. Yet it's a digital bank backed by one of the largest tech and e-commerce platforms in all of Southeast Asia. The cross-selling potential is enormous.
Hidden catalyst number 3, and this is the mathematical behemoth, the missing gigawatts.
This is where the engineering scale gets genuinely exciting. Management recently raised its strategic data center target to a total pipeline of 2.4 gigawatts.
Let's put that in perspective for a second. 2.4 gigawatts isn't a building. That is roughly the power consumption of a small country or a major metropolitan city.
It is an incomprehensible amount of power, and currently the broker models are mostly only pricing in the first 1 to 1.2 gigawatts located at their Kulai campus. Over 54% of their newly upgraded pipeline is essentially unpriced. Specifically, they just acquired 145 acres of land at Sednak Tech Park West, or Step West.
145 acres. And they have an option built into the contract to acquire 400 more acres there, bringing the total potential capacity to a mind-numbing 3 gigawatts. How can analysts ignore that?
They don't entirely ignore it, they just require more certainty before putting it in a target price. RHB actually ran a speculative scenario test in their latest report. They noted that their current RM 7.00 model assumes a RM 33 billion enterprise valuation for the 1.2 GW capacity in Kulai. If YTL successfully ramps up the unvalued capacity in Sednak, RHB estimates it would add another RM 2.90 per share in pure, unadulterated upside.
RM 2.90 of pure upside, just from the land they already secured and the power they already have access to. If you add RM 2.90 to today's price, you're looking at an RM 8.00 stock. Which brings us to the fourth hidden catalyst, the financial maneuver that could unlock it all, the 2027 IPO.
YTL Power is openly planning to list its data center unit as a separate entity in 2027. We talked earlier about how conglomerates often trade at a conglomerate discount because their structures are messy and hard to value. If you spin off the pure-play AI data center business into its own publicly traded entity, the market will aggressively re-rate it.
It stops being compared to slow-growth water companies and starts being compared to global tech infrastructure REITs like Equinix or Digital Realty, which trade at significantly higher multiples. It instantly unlocks all that trapped value for the parent company shareholders.
Exactly.
Okay, so with all that massive upside potential laid out, let's grade their defenses. Let's look at the financial moat scorecard and management strategy. Our internal analysis gave YTL Power an economic moat score of 8.6 out of 10. That translates to a wide moat. Let's justify that high score, because a moat is your ability to fend off competitors over a decade.
Right. YTL Power achieves an 8.6 because of its unique hybrid investment profile. Let's break down the two halves. First, the shield. The defensive side of the moat.
Okay, what's the shield?
That shield is the regulated water assets in the UK and the power grid infrastructure in Singapore and Malaysia. These operate under legal monopolies or highly regulated long-term concessions. You can't just wake up tomorrow, raise $1 billion, and build a competing water pipe network next to Wessex Water's pipes in the UK.
Right.
It is legally and physically impossible. The barrier to entry is essentially infinite. This acts as a reliable shield, throwing off predictable cash even during severe global economic recessions.
On the sword, the offensive side of the moat.
The sword is the explosive, high-barrier NVIDIA partnership. Securing an allocation of NVIDIA's most advanced, highly sought-after AI chips right now is incredibly difficult globally. There's a massive wait list. YTL secured them. Furthermore, building a green 500-megawatt solar-powered data center campus requires massive contiguous land, massive upfront capital, and massive power generation capabilities, which, crucially, YTL already owns via their legacy business.
Wow.
The barriers to entry for a new competitor trying to replicate that massive ecosystem from scratch in Malaysia are immensely high.
So the moat is undeniably wide. But how is management actually steering this massive, highly leveraged ship? Because rolling out 2.4 gigawatts of capacity while navigating a RM31 billion net debt load sounds absolutely terrifying. One misstep and the whole thing collapses.
It would be terrifying if they were financing it poorly, but a key, brilliant component of management strategy is their use of non-recourse project financing.
Non-recourse. Let's break that banking jargon down for the retail investor. What does that actually mean if things go terribly wrong?
It is a method of ring-fencing risk. It means the debt they take on is tied specifically to the individual project entity, like a newly formed subsidiary, just for one specific data center building. The loan is secured to the cash flows of that specific building, and crucially, it is not guaranteed by the parent company, YTL Power International, as a whole.
Meaning, if a specific AI project fails miserably, the bank can seize that specific building and the servers inside it, but they legally cannot come after the parent company's other assets, like the UK water business or the Singapore power plants.
Precisely. They are effectively isolating the blast radius. It ensures that every single new project has to be commercially viable on its own 2 feet before a bank will agree to fund it, and it protects the mothership from sinking if one highly speculative venture fails.
That is a very disciplined approach to aggressive expansion. We also have to mention their ESG strategy, which factors heavily into institutional holding. They have an overall ESG score of 2.9 out of 4 from RHB, which is considered good to excellent.
Which often confuses people. How does a power company burning fossil fuels get a good environmental, social, and governance score?
I was just going to ask that. They literally boil gas for a living.
Because ESG scoring is heavily weighted toward the transition plan. For example, they are actively commissioning a 600-megawatt hydrogen-ready combined cycle gas turbine plant in Singapore, slated for completion by December 2027. It will be at least 30% volume hydrogen-ready from day one, significantly reducing its carbon footprint compared to legacy plants.
Oh, that's smart.
Plus, they are building massive solar farms in Johor to directly offset emissions and power the green data centers. They are actively managing the transition to renewables, which keeps massive institutional funds, which have strict, non-negotiable ESG mandates, safely invested in the stock.
So, what does this all mean? We've painted a very bullish picture of massive hidden upsides, 3-gigawatt pipelines, and wide defensive moats. But I have to play devil's advocate here. Let's look at the risks in future growth. With the stock up 600% from its lows, is it still safe for a retail investor to jump in at RM5.36? Is this stock currently priced to perfection?
If we connect this to the bigger macroeconomic picture, absolutely no stock is without risk. At roughly 20x forward earnings, the market fully expects them to deliver on these massive promises. If they stumble, the stock will be punished severely. Let's lay out the critical risks.
I'm ready. What is risk number one?
The cash cow sneezes. We literally just saw it happen in Q4 with the Iran war disruption. The primary risk is a margin squeeze in Singapore. If the Singapore power market gets overly competitive, driving retail tariffs down, while at the same time global gas prices spike due to conflict, they get squeezed on both ends.
And if the Singapore cash cow sneezes, the massive CapEx funding required for the AI data centers gets a very nasty cold.
It certainly does, which leads directly to risk number 2, delays in data center commissioning.
We talked about the liquidity tightening earlier. The current ratio is sitting at a precarious 0.81x.
Right. They are spending billions of ringgit today for revenue that won't arrive until tomorrow. If there are construction delays, if there are supply chain bottlenecks getting those NVIDIA chips into the country, or if there are delays in getting tenants online to generate those run rate revenues, the cash outflow continues without the corresponding inflow.
With a tight current ratio of 0.81x, any severe multi-quarter delay could cause a real tangible cash crunch, forcing them to raise highly expensive emergency debt or violently dilute shareholders to bridge the gap. Execution is absolutely everything. They have to build it on time, on budget. But assuming they do execute, what does the immediate future growth look like to offset those risks?
In the near term, those Singapore retail contracts that suffered margin compression recently are expected to expire. They will be repriced at much higher tariffs in December 2026 and January 2027. That should provide an immediate, powerful boost to PowerSeraya's profitability, refreshing the cash cow.
And on the tech infrastructure side, What's the immediate catalyst?
That massive new Sednak land we talked about, it isn't just an empty patch of jungle. The broker reports highlight that it includes immediate, ready access to water and electricity supply.
That's huge.
It is a critical advantage. It allows them to completely bypass years of tedious infrastructure setup and accelerate construction immediately, allowing them to ramp up capacity by an incredible 400 megawatts annually just to meet robust market demand.
400 megawatts of new capacity a year. It's just a staggering scale. Okay, we have covered a massive amount of ground today, tracing this company from 50-cent stagnation to RM5.30 AI-driven hypergrowth.
We've dissected the 10-year cycle, debated the Q4 balance sheet liquidity, mathematically modeled the SOTP hidden upsides, and laid out the severe execution risks.
I want to take a moment to give a massive, sincere thank you to the specific viewer whose comment on our previous Carlsberg ingenting video actually inspired today's massive YTL Power deep dive. You know who you are, and this extensive hour of analysis exists purely because you asked the right question at the right time.
It is absolute proof that we read the comments and we build the highly detailed institutional level content you want to see.
So to everyone listening, let us know your thoughts in the comments below. Did we miss a hidden catalyst? Are you terrified of the RM31 billion debt load? Please like, subscribe, and check out our other deep dives on the channel. We will see you in the next one.
But before you close your app, I want to leave you with one final provocative thought to mull over this weekend. We've talked extensively today about YTL Power transitioning from a traditional utility to a tech giant. But if they successfully execute this massive 2.4 gigawatt pipeline and they successfully IPO the data center unit in 2027, the real question is this: will YTL Power eventually cease to be viewed as a Malaysian utility company entirely? Will it shed that identity completely and instead become the de facto monopolistic landlord of Southeast Asia's entire AI revolution? What happens to the valuation if the global market completely stops comparing it to boring power companies and starts pricing it like Silicon Valley tech infrastructure? Think deeply about that before the market opens on Monday.